What if I told you to look in your bathroom cabinet for your next investment? I'm not kidding. You probably have products from Kimberly-Clark and Clorox right now. And that boring roll of toilet paper might be a smarter investment than the AI company that you've got your eye on. Now, I know that sounds crazy because the market has been avoiding consumer staples over the past few years. You want to know why these stocks are so hated right now? It's simply because they don't make for exciting headlines or YouTube videos. But that's about to change as the current bargain prices will disappear for years to come. As a longtime dividend investor, it's easy for me to see why I want consumer staples in my portfolio. It doesn't matter if interest rates are up or down. It doesn't really matter the state of the economy. People are still buying toilet paper, bleach, and other pantry staples. It's no coincidence that over 20% of dividend aristocrats and 25% of dividend kings are these boring companies. This consistency allows you to hold these companies for years or even decades, reinvesting the dividends to grow your wealth exponentially without constant supervision. But there are two catalysts on the immediate horizon that are going to trigger investors to remember that consumer staples exist. First up is economic uncertainty. If it looks like we're headed for a recession, then investors will want to own recession-resistant companies. The rip-roaring stock market has kept us out of an overall recession thus far, but I'm not sure how long that's going to last. 2, lower interest rates. If CDs and other banking products offer decent yields with FDIC insurance, investors are going to take those opportunities. But as interest rate decreases trickle down through the market and those yield drops, investors will turn to consumer staples. When the rest of the market remembers that boring dividend stocks exist, prices will go up and yields will go down. So the best time to lock in your entry price on these increasing yields is right now. Want to know my two favorites? Kimberly-Clark, ticker KMB, and Clorox, ticker CLX. Both have an annualized yield of over 4%, which is above average for both of these companies and for consumer staples overall. And both are trading at long-term support levels. This is essentially a price floor created by investor supply and demand, which means shares won't stay at these bargain prices for much longer. So the next time you reach for something in your pantry or your bathroom cabinet, flip it over to find the parent company. You might just find your next above average yield at a price too good to pass up.